Welcome back to Module 1, Introduction to Real Estate Investing. This lesson is why invest in real estate. We did cover in the course overview a few reasons why real estate has great wealth building effects. Let's cover those in a little bit more detail and put this topic to bed once and for all. First of all, real estate is a physical asset, a tangible asset, can be seen, touched, and utilized, unlike some things that we're familiar with. Digital bank accounts, paper currency, stocks online. This is less likely to become completely worthless. Land and associated buildings on the land are always going to have value. So this intrinsic value is going to provide a sense of security and stability, unlike a lot of other assets that are less tangible. The appreciation potential of real estate has two forms. First, you have the gradual market-based appreciation. Over time, real estate does tend to appreciate in value very consistently. Historical trends that show that property values rise almost every year, providing the investors in it pretty guaranteed returns year in and year out. There are market downturns in real estate, but they do often recover very quickly within a year or two, not 5 or 10 years, and then they bounce back very strongly and continue the gradual appreciation, making it a very strong long-term investment. You also have the forced appreciation, which is based on some improvement in value, normally coming from a rehab-based or renovation project. This is very quick and sudden and large. Many investors do not want to participate in rehab activities or don't know how to. Part of this course is to help you think about that. So the forced appreciation potential should not be ignored. It's very significant. We have the cash flow. Cash flow is going to come in when you own rental properties on a monthly basis. Owning rental properties is going to generate a steady stream of passive income. To which extent it's passive is not the same with every investment. There may be property management in place, or you may do everything yourself. If you're smaller, you're going to probably start managing things yourself until you get big enough to hire some property management. The rent payments can cover not only the loan expenses, the taxes and insurance and repairs and the like, and still produce a profit every month. So this consistent cash flow can supplement income and build financial independence. A lot of people love real estate for the fact that having $2,000, $5,000, $10,000 of income across several properties is a way to live without necessarily having a job. Maybe financial diversification. If you lose your job or quit your job, you have some other way to live for some period of time. And if you get big enough, you can totally quit your job and have enough cash flow to live on and live on very well. So a lot of people are searching for that. We also have significant tax benefits for real estate investors. These include the deductions for expenses associated with the property, the taxes and insurance, repairs, and the like. These can come off the rent income, of course, but the big one is depreciation. When you have long-term rental holdings, you can use depreciation to, over time, make significant deductions every year. This is not applicable to rehab properties held on a short-term basis. This is covered later in the course, but the depreciation is used to knock out or reduce taxable income coming from other sources. If you have a high-paying W-2 job, having 20, 30, 40,000 of depreciation across some properties every year can really knock out your taxable income to a lower level, decrease your taxes a lot, and really produce savings on taxes that can be invested in more properties or other investments. Very significant. That's why wealthy people tend to go to real estate, because it can offset a lot of their other income. Next, real estate allows investors to use leverage, meaning you can buy properties with borrowed funds. This is going to amplify what you can do compared to cash alone. When you use leverage, you can take your assets 3, 4, 5 times higher, and you have these assets now subject to the market-based appreciation. And a wonderful compounding effect takes place when you have these larger assets subject to the market gains. This is going to be much, much higher than you could see with just cash returns. We'll show some actual examples using numbers in later lessons. But the lesson here is that just using leverage is going to greatly amplify your return possibilities. It's what's called using good debt to buy assets that appreciate. You are also seeing the debt pay down on the financing every single month by the tenants when the rental payments come in. The debt gets paid down every single month. So over time, you have the asset of the property value increasing month after month, and you have the liability of the debt going down every single month. This is going to increase your equity month after month in a very, very attractive way. We also have a diversification situation happening with real estate. Real estate is going to move differently from stocks and bonds and other type of assets, so your overall portfolio volatility will be lower, less extreme. This is going to be a nice safety against market fluctuations and economic downturns. The stock market can be very exciting, but it can also be very dangerous. Real estate is going to soften that quite a bit, which is really, really necessary to have a peaceful sleep at night. Let's put it that way. We also have an inflation hedge for real estate. It's a very effective hedge against inflation. As we've seen in the last few years, inflation can get very severe. The good news is when you have real estate holdings, property values and rental incomes tend to increase at the same time, very, very much in step with the general inflation of everyday prices. So your purchasing power of the invested capital is going to be protected to a large extent. Very, very important point here. We also have the legacy and wealth building aspect of real estate. Real estate investments can be passed down to future generations, creating a lasting legacy. This type of intergenerational wealth transfer is something that can provide some financial security for your children and their children, and perpetuates family wealth. A lot of people get into real estate really to pass down a nice amount of wealth to their children and set them up for maybe an easier, nicer way to go in life after you've done all the work of building the portfolio. Um, Finally, we have control and flexibility. Real estate investing is going to offer a high degree of control and flexibility compared to a lot of other typical investments. Stocks, you're not going to have much say whatsoever in how those investments go. You might have a stock vote, but there's hundreds of millions of shares with voting power, so there's no real ability to influence your stocks at all. You're just kind of subject to those going up and down every day and every month. But real estate is going to allow a hands-on approach for you to do certain things. You can renovate properties, you can design new construction, you can choose where to invest and what type of properties to invest in. So you really have a great deal of management control over how your investments perform, their value, and their return. In summary, investing in real estate combines these different factors to make it an attractive and robust strategy for building and preserving wealth. So we've covered this ground now, I think, in good detail. We don't need to come back here. I think we're all in agreement that investing in real estate provides a very good benefit to your financial health. Now, I'd like to finish this lesson by taking a look at the cash flow quadrant. This is from the Rich Dad, Poor Dad brand of financial education. This is going to highlight 4 different ways to generate income. We have employee, self-employment, business owner, and investor. This is going to provide a framework for transitioning from trading your time for money to achieving financial freedom by getting assets to work for you. On the left side, employees and self-employed individuals are prioritizing security, but rely on active effort to trade time for money. Employees work for others, earning income only when the employee shows up to work. While having a job is often perceived as secure, it's actually pretty fragile. Job loss can happen at any time, leaving income streams abruptly cut off. Meanwhile, self-employed individuals work for themselves, gaining control, but often taking on the burden of doing everything to run the business. Entrepreneurs in this category frequently work longer and harder than employees, leading to burnout and disillusionment as they realize that income is still tied directly to their active effort. The right side focuses on freedom and passive income more so. Business owners create systems and hire employees to run operations, generating income for the business owner without necessary daily involvement. Investors, meanwhile, grow wealth through assets like stocks or real estate, which work to generate income with minimal effort on the part of the investor. This is the ultimate goal for anyone seeking financial independence, which leads to freedom. In its own way, security. Making the transition from the left to the right is going to require a strategic shift in mindset. and your actions. Instead of relying solely on earned income and therefore trading your time for money permanently, you begin acquiring income generating assets to do more work for you. For example, a dividend investor will earn passive income as stocks generate regular dividend payments, while real estate investors generate cash flow from rental properties and benefit from long term appreciation, among other ways that real estate builds wealth. Both of these strategies allow your money to work for you rather than the other way around. Meanwhile, tax laws also favor investment income over earned income. Capital gains and dividends from your investments are typically taxed at lower rates than wages. It's hard to pay higher taxes with wages, but that's the actual tax law. This allows investors to retain more of their earnings when the cash from investments is taxed at a better rate. Additionally, investments like real estate, as we've described, offer tax deductions such as depreciation, which can significantly reduce your taxable income. So these tax advantages make the right side of the quadrant even more attractive for those seeking to build wealth efficiently. Real estate is especially popular for this transition, offering both consistent rental income and the opportunity to build equity over time. The journey typically starts with earned income, used to acquire initial investments little by little, and gradually shifting towards asset driven income streams when it becomes possible. So the goal is clear: move from trading time for money to building wealth through assets and making passive income without trading your time for money. This shift not only provides financial freedom, but also reduces tax burdens and unlocks time to focus on what truly matters with your newfound freedom: family, creativity, artistic endeavors, travel, hobbies, personal fulfillment, etc. So, if we look at this one last moment, typically the transition is moving downward from employee to self-employed and over to investor. But the whole goal is to get to the investor quadrant on the bottom right so that you maximize your income. It's not tied to time. You're making money when you're not actively working. You're minimizing your taxes because you have tax favored income. You're using good debt to acquire the assets and ride the assets as they appreciate over time and compounding your wealth. Finally, I want to commend you one more time for taking this course. You're actively taking steps to move from the left side of the framework to the right side. You want to stop trading your time for money always, and you want to work smarter and not harder. So let's continue on the journey to becoming a successful real estate investor.